Okay, so I'd like to get started. Today's speaker is David Pennock. I've known David for a long time. We were at NEC Research together. And after that, I went back to academics, but David bounced around various companies, first working for Overture. After NEC, he worked for Overture, which is the company, and that eventually got bought out by Yahoo, so it was in Yahoo Research for a long time. In fact, it's because of David that we have the Yahoo sponsored lunch. But as of Friday now, David's now works for Microsoft Research. So I guess are you our first talk as a Microsoft employee?
Yeah.
Oh, look at that. So, and will Microsoft buy us lunch in the future? Well, we'll see. Anyway, today he's going to talk about prediction markets. No surprise. Tractable combinatorial market maker using constraint generation.
Thanks a lot, Lance. Thanks for this opportunity. It's great to be here. Great to be back. Thanks, Jason. So I'm going to talk about this market maker for a combinatorial prediction market, and it's work with a couple colleagues of mine at Yahoo, Miro Dudik and Sebastian Lehay, and some other people were involved in this as well at Yahoo and also at Princeton. But I guess before I dive into the details of this particular paper, I just want to start a little bit non-standard in a technical talk, but I just want to go up a level and talk about the big picture a little bit of where this all fits. So I think this market maker that I'm going to tell you about is one example of what we call algorithmic economics, which is kind of this intersection between computer science and economics. So kind of bridging the gap between computer science and economics. So thinking about computer science from an economic point of view, so thinking about not just thinking about incentives, so not just thinking about worst case behavior, but thinking about rational agents and how they would behave in a computer system. And then also the flip side, thinking of economics from the computational point of view. So not just thinking about unbounded rationality, but thinking about designing mechanisms with computational complexity in mind, and thinking about how you design algorithms for markets and actual building them, the actual engineering practice of building markets. And of course, thinking about how we can take advantage of the computational power we know about, like optimization and machine learning, to improve our market systems. So just an idea of how I think this is, how computation is changing economics. If you think about all the markets that you think of, that you interact with, they were all designed, or most of them were designed before computers even existed. So like think about an auction. It used to be like Sotheby's style. There was a person at a lectern. An auction was conducted by a person. And similar there used to be people in Wall Street actually on the trading floor exchanging pieces of paper. And advertising was about calling people on the phone and getting on a golf course and making deals. But we know those things are changing. So now an auction is a very, very mechanized rule procedure. So it makes sense that it should be done by a computer. Computer can do it faster and cheaper and in many ways better. So auctions now are more in eBay. Almost every auction you think about is done by a computer now. eBay, Wall Street, even advertising now is done more like you submit a bid for what placement you want, and it runs more like an auction on a computer. That's what I would call maybe phase one of this this evolution, where basically the computers are doing exactly what people used to do. eBay is not doing anything really different than that person on the lectern in Sotheby's was doing, but it's just done by a computer. But then what's happening is what you might call phase two is, well, it's all being run by a computer. Why is it still working in this very simplistic way that, it had to be simple because it was a person doing it, but now it's being run by a computer. We know, we have a lot more power to do the optimization that, human can't really do manually. So now this phase two is, not just cheaper, faster, but also better. So we we can have expressive auctions, very, very complex, or put it this way, very expressive bids that, and then the center can use optimization to find the best clearing. Or you can have very expressive, for example, in finance, you can do very customized insurance. Or in advertising has now become very sophisticated where you can specify exactly what targeting criteria you want, what user, what time of day, and how much you're willing to pay. And then the center basically has an optimization problem to solve to clear the auction. So that's what I might call this phase 2.0. So just to say it again in a different way, phase 0, everything was happening by people. The center was a person, and so were the bidders in this kind of mechanism. Phase 1, which already is almost everywhere today, everything is done by computer. The center and even the people are now using a computer basically to, why sit around all day in an auction house? You should just have your computer agent do it for you. Kind of what happened interim is like, and this is where we are in many cases, like for example in finance, this is the way the world looks. Like a phase 1.5, the center is still the center still behaves in finance. If you think about the way stocks are sold, it's still this very simple continuous double auction rule. It's the same thing that people used to do on the trading room floor, but now done by computer. So that hasn't changed much. But what has happened is the bidders, like these are the hedge funds, for example, have gotten very, very sophisticated. They are using machine learning, optimization, using full power of computation to like eke out as much as they can out of this simple mechanism. But what's happening, and what will be happening and continues to happen, is that the center is also getting smarter. So this really has happened in advertising already. And I think it's happened to lesser extent in finance, but the example I'm going to give you is how this may happen, at least in prediction markets, which I consider kind of like a sub-case of finance or a special case of finance. Okay, so now I'll get into my example. So that's kind of my big picture. Now let me tell you about this, an example of what I think is moving into a phase 2 of into the phase 2 type situation. So I'm going to talk about this prediction market area. So let me just very briefly tell you what is a prediction market. It's basically a mechanism to get a prediction for something that you might find, something where you might want a probability estimate. So this is something useful, right, or something interesting that you might want to know. What is the probability that our economy, the U.S. economy, will go into recession this year? It might affect how you make decisions. It might affect how you vote. It might affect how you invest. It might affect what job you take. So it's a number that might be useful, and even if it's not useful, it's something you might like to know. What's this probability? So what is a prediction market? It's basically you take something like that you want to predict and just turn it into a financial instrument. So that pays $1 if that thing happens and is worthless otherwise. So then you can think about how much would you pay for this coupon? Well, if you're roughly risk neutral, you'll pay about what you think the probability is of this happening. And then if lots of people are buying and selling this thing, and it reaches some equilibrium price, in a way that's like the consensus where nobody's willing to change. So many people have come. It's kind of the consensus opinion of what people think is the probability of that happening. So who wants to take a guess? What do you think the probability of this happening is? Or how much would you pay for this coupon?
$0.20.
35 cents.
What?
We said 35.
35 cents, okay.
Wow.
Oh, somebody said wrong, so.
10 cents.
8 cents.
Okay, so the two of you should get together and get into a contract. You could place bets with each other, I think, because you disagree. So that's the concept here is people disagree and they can bet with each other, but we'll reach some kind of equilibrium. So and this is not just hypothetical. You can go on this website, InTrade, and actually trade. You can put real money and buy this contract. U.S. economy will go into a recession in 2012. This works exactly like a double auction, just like the stock market. This is the bid queue, and this is the ask queue. It's a little bit, the UI is not the best, but basically the last trade price is saying, and according to this market, there's a 13.6% chance. Actually, what you should look here is the bid price and ask price basically says, according to this market, there's between an 11.7 and 13.8% chance of the recession happening. So if you disagree, you can go on this website and put your information into the market. Oh, the reason here is these contracts pay $10 if you're right, not $1. That's why the decimal point moves. Any questions? Yeah.
So for a market like this, when is the market stop?
Oh, well, this one will stop, I think, December 31st. Oh, I guess it will stop the way it's defined is something like whatever the definition of recession. It's like two consecutive quarters of negative GDP growth. And in that case, it would pay off at $10. But if December 31st, 2012 comes around and that's not true, then it'll pay off at 0. Yeah, please stop me with questions along the way. Okay. So this is InTrade. One thing interesting about InTrade and on Wall Street and a lot of these markets is there's a lot of related markets. I'm talking like very strongly related, like logically related. Like you could bet that Ron Paul wins Texas, or you could bet he finishes in second place in Texas. Well, you know for a fact that both of those cannot be true. And of course, if he wins Texas, then he has to have also, this contract has to be true, that he wins at least one state, right? These are all related, whether he's you can't be the GOP nominee and the GOP VP nominee. And if he's the VP nominee, then someone else can't be VP, etc. Romney can't really win the presidency unless he wins the nomination, etc. Okay, there's even more relationships here. Like on InTrade, you can actually bet on all combinations of these things. Democrat wins the presidency, Democrats retain the Senate, and Democrats retake the House. Or every possible combination. I guess there's 8 possible combinations here, right? And they have these individual ones. Like, of course, you can bet on whether Democrat wins the presidency, Democrats win the House, or these things like Democrat wins more than or equal to 270 electoral votes. That's exactly the same as this. Or they win more than 280 electoral votes. And of course, if this is true, then that has to be true too. So all these things are highly related. Another thing is the price of this, right, has to be equal to the price of the sum of all these. You see that? Right? All 4 of these things together, sum together, is exactly the same event as this, right? But the way InTrade works and the way all these markets work is all these things operate independently. So as far as InTrade's concerned, that's why this is sort of the phase 1 type situation. As far as InTrade concerned, this is totally different market than this. And in fact, it's totally different than this. And they don't enforce any pricing consistency among these. So as far as they're concerned, it could go out of whack where the price of this is greater than the price of that. But we know logically that's impossible, or the probability is certainly impossible for this probability to be. Sorry, the other way around. It's impossible for this probability to be greater than that. So the market sort of pleads ignorance and says, I don't really know about these relationships. I'll just treat them totally independent. And really, that's the way the whole industry works everywhere. In Las Vegas, in horse racing, on Wall Street, if you think about stock options, every single strike price, every single expiration date is just another continuous double auction. And the exchange just treats them all totally independently, as if they weren't related at all.
No, horse racing doesn't quite work like this, does it?
It kind of does. Even in horse racing, when you bet to win, your money goes in one place, and when you bet to finish first or second place, your money goes to a different pool, and the odds are set separately for these two things.
If I bet on two different horses, it could really affect. Like if I bet on horse A versus horse B, those things sort of sum up.
So all the so within the win race, like if you're betting on who's going to win, you're right. If you bet on a certain horse to win, that might decrease the odds of another horse to win, but it does not affect the odds to finish to show, which is or no place, I think it's called, which is finish first or second place. They don't, and there is a logical relationship, right? You can't. If you win, then of course you also finish first or second. So, okay. So what we are trying to design is a combinatorial prediction market where all of these relationships happen automatically. So the way this works, okay, let's think about the election. You can bet on any state, like who's going to win in any state. Just assume there's only two candidates, either Democrat or Republican. There's 50 states. Actually, there's 51 because Washington, D.C. is another one. And now the payoff of a combinatorial security is any Boolean function, is basically a function of those 50 variables. So you can have any Boolean function of 50 variables. That could be your payoff of your security. So a simple one is the one that Intrade already has, which is you can bet, I think a Democrat will win in California. But you can start to do like other formulas. Like I think Ohio and Pennsylvania will go the same way. They'll either both be Republican or both be Democrat, but I don't know which. Or I think Democrats will win at least 8 out of the 10 northeastern states. Or I think Obama will somehow lose Florida, but still somehow win the election. These combinations, or any Boolean function, right? So you could say, I think Lance came up with this one. I think that there will be some path of blue that goes from the border of Canada down to the border of Mexico. And we want all these things to be logically connected. So if a lot of people are betting these up, the probability of all three of these are high. It should be automatic that the price of this goes up also. So questions at this point? So this is what we're trying to build. This is kind of what the mock-up of what it would look like. You make your prediction. I think Democrat will win in California. I'm risking this many points. If I'm right, I'll win that many points, and I make my prediction. For these more complicated things, like you can't do everything on a map, right? This doesn't. It's hard to think of a map interface. So what we've done this kind of market in the past for sports, and what we did is like a wizard type interface where you first pick the type of prediction you want, and even in this wizard type interface, there's millions of different predictions encoded in here if you drill down into them. Like you pick a type of prediction, say comparing two teams. This is like for sports. I think Duke will go further than Connecticut in March Madness. And then it pops back. It says the odds are 59% chance of that happening according to the current market. Well, that's what the market thinks. And you say how much you invest and how much you'll win, and you make your prediction. And then it's one nice thing is you can sell at any time, just sort of like the stock market. So if Duke is losing and about to get knocked out, you can sell your contract right then, and maybe you won't lose all your money, but just part of your money. So it was very rewarding to do this. So for example, in 2011 March Madness, we had this streaming thing which showed us all the predictions people were making. This is what we did at Yahoo, and these are an example of one day where we could just watch all the predictions people were making. And like 10 seconds ago, someone predicted that. 10 seconds ago, 23 seconds ago, someone predicted that. So we're at sometimes we were getting a huge amount of traffic. It's kind of a great feeling to think that something you created was getting this kind of interest. And another thing that was interesting is, so we had this highly expressive bidding you could do, and people were really taking advantage of that. So they weren't just saying who would win. They were picking these kind of complicated things, like here's a three-way one. Duke will go further than North Carolina and Kansas State. So, and actually there's 4,000 different of these that people made, of these like three-way complicated predictions. So there was a lot of unique predictions that people made. They weren't just doing the simple ones. Yeah.
When you say made a prediction,
yeah,
you mean just believes it's one way or the other way of the buyer ask price?
It means they.
Because you have a probability you think that this event will happen.
Right.
But you're not asking people to report that.
That's true.
Asking people just to buy or sell at the current price.
That's true. I think it's higher than the current price, or I think it's lower. Yeah,
and
that's
so,
right.
You know, the probability could be 0.10, and I think it's higher than that. So I'm going to make a prediction that the opposite, that it's going to. You see what I'm saying? It's
although
reporting like not that predicting this is different from predicting that's bigger than the current price.
Well, that's partly true, but you have this other knob, which you say how much you're willing to risk, how much you're willing to bet. So, and the way the market maker works is the more you put in, the more you move the price. So technically, if you were risk neutral, you would just keep moving the price until it reached your probability, or you would run out of money. So there's a little bit of encoding of how strongly or how much higher you think the price is. But this is just a fun picture of what. So I think we ended up with a pretty nice looking UI that the engineers at Yahoo helped us put together. But this is like a look at what the scientists came up with in terms of UI. So this is our prototype UI. Like the first one we had was done in Mathematica. Our first prototype was in Mathematica, and then we did another one in PHP. And in this what?
You can still do this one, right?
I don't know. we should get it back going. It is kind of cool in some sense. Like to enter a prediction, you like type in a little snippet of PHP code, like wins of Duke greater than wins of UNC. Or here's a crazy one. Like if you ever use PHP, it has these crazy function names. But this basically says, take the sum of all the seeds of teams in the Final Four, and is that a prime number? And so you can make any arbitrary prediction like that. So it's more expressive, but our average Yahoo user probably wouldn't want that. And I guess it also is a little bit of a security problem. Okay, so now I'll get into this kind of specific result on this paper. This paper will appear in EC 2012 this summer in Valencia. Well, okay. So any questions of like the whole setup?
Yeah. When Yahoo comes back and says what the odds of something are for some complicated event, how is it figuring that out?
Okay, that's what I'm going to talk about. This market maker. So yeah, we're running this market maker algorithm that any kind of crazy proposition you come up with, the market maker is forced to at least give you some price. So it will always take your bet. It won't, but at its price. It will take every single bet, but not necessarily at every price, but at a price of its choosing. And so you try to design the market maker such that you can guarantee it won't lose too much money. Okay, so they'll tell you about our strategy for setting these prices. So this is kind of a look at where we fit, where our solution fits. This is like the industry standard I mentioned, the kind of phase 1.0 thing. Like InTrade is an exchange. It means it's just like the stock market. The InTrade takes no risk. It's just running this exchange, matching people up, and everything is independent. So it's taking no risk. It's tractable, of course, but there's no information propagation. So between these related securities, there's no automatic propagation of information. You could have a combinatorial exchange where you're still not taking any risk, but you're starting to propagate information among these securities. And actually, this problem is NP hard. But maybe even more of a problem, like you said, if someone comes up with a crazy proposition, like I think there'll be a path of blue from Canada to Mexico, it's hard to believe, it's hard to imagine that there just happens to be someone else willing to take the opposite side of that bet in the system. So I think there'd be like a huge liquidity problem trying to run a combinatorial exchange. So in this combinatorial case, I almost think you have to have a market maker, someone there who like for any crazy proposition, they'll come up with some price. But that problem to do like in exact case is sharp P hard. But the nice thing is, the good thing is it like automatically propagates all information exactly as you would want. The other good thing is you can prove that it won't lose more than some bound, which is linear in the number of base outcomes, like basically linear in 50 in the election example. Whereas the market maker, if you ran a market maker on every single proposition, every single of all 2 to the 50 states, then that thing could lose an exponential in like order of 2 to the 50. So independent market makers could lose up to 2 to the 50, whereas this one is bounded by a 50, in the election example. But also in this case, there's no information propagation. So, okay, why do I care? You might ask, like, why do I even care about this information propagation between related securities? Why not just let the traders? So what happens in Wall Street and everywhere? The traders kind of keep things consistent, because if it's not consistent, they can make a little bit of money. I guess the whole point here is this is a prediction market, meaning my goal is to gather information. It's a little different than in finance, where my goal is to maximize trade. So my goal is to get information. So I want to actually reward people for information. I don't want to reward them for finding these little arbitrage tricks. So I don't want to reward people for just having a lot of computational power, like being a hedge fund or whatever. I want to reward them for actually providing useful information. So that's my motivation for wanting to do the information propagation. Anyway, that's like a very mechanical task that a computer is way better at than a person. So why not? We should have the computer do it. So this is what our approach is. This is sort of where we live. It's a market maker solution. We try to keep, it is polynomial time, deterministic approximation of this. So we have some information propagation, but not complete. We can't have complete because that's sharp P hard. But and we have we have a good loss bound in practice. I guess in theory our loss bound is exponential, but we can prove that it's better than this, and we can show in practice it's way better than that. Yeah.
So one difference between the exchange model and the market maker model
Right.
is, so in the exchange model, you're just basically holding bets people are making. If someone wants to match, then you make that match.
Exactly.
And so there's no risk for the market maker.
Exactly.
But for the market maker problem, you have to accept all, or you have to offer a price for
Exactly.
all bets.
Exactly.
And if someone takes that price, you have to take it.
Exactly.
And that's why there's a loss.
Exactly. Yeah.
And you can't build in some kind of margin in that?
You can.
Make
So,
that
and
loss,
that's
or
the
if
way.
you do that, then
You could never guarantee you won't have a loss. So that's the way a real market maker works. They have some margin, like a bid-ask spread, and they think like in expectation they'll make money, and maybe they're right, but they could never have this sort of absolute worst case. This bound is a worst case thing. It's like, and the absolute worst case, even if no matter what trades happen and no matter what outcome happens, I know for a fact I'll never lose more than some amount. So you can't get around that. I mean, if you're going to have a market maker, you have to have some worst case loss. But you might hopefully have like expected gain.
I mean, presumably, if you're collecting information, you've got some pretty reasonable beliefs, and then you allow bets that, given your beliefs, they wouldn't give you a loss. Is that right?
I think you could. Well, I mean, there are market makers in real life that make a living doing this kind of thing. So I think it can be done. That on average you'll make money, but I don't think there's no way to like prove that you'll never lose money. But, okay, so we this is the way it works conceptually. We basically, it's a lot like the independent market case in one sense. We start off with independent market makers for individual securities and for small groups of securities. But then in parallel, we have this constraint generation to find arbitrage and get rid of it. And so, and it's all embedded in like a convex optimization framework. That this is the paper. If you read this type of work, this is the Abernethy and Chen and Wortman. So it's building on this convex optimization framework for a market maker. And this is a deterministic approximation. So what we did, that thing I showed you for the for Predict-A-Lot for March Madness, we were doing this Monte Carlo sampling. So we're doing a different kind of approximation. And I think this user experience will be better. That is one thing users complained about, this kind of very volatile pricing. So a nice thing about this is it kind of separates the pricing. So pricing, you have to be able to give a price for any bet, right away, almost instantly. And that has to be fast. So we separate the pricing, and then information propagation can happen in parallel. We have a new method to derive the loss bound. And one interesting part of the paper, one of the more interesting parts, I think, is we actually evaluate this on, we got a pretty interesting data set from Princeton where they had 300,000 predictions of exactly the type we want, these kinds of probabilities of pairs of states or triples of states. So we do a kind of pseudo-synthetic simulation of, and we're, like I said, we're building this thing out to actually see how it works in real life. So let me show you how this pricing works. Okay, think about two related securities. This could be like I showed you. This is like Democrats win the House, the presidency, and the Senate, presidency, House, and Senate. And this one is Democrats win presidency and Senate, but Republicans win the House. So these are related securities. If like on InTrade, there's no constraint of the price except what traders might decide. So the price can go anywhere. Price could be anywhere between 0 and 1 on either axis. But so the way this works is we might know something more, like let's say we know the probability that Democrats win the presidency and the House and the Senate. These numbers are not the same as they are on Intrade right now. But so what do we know? We know for sure the price of this has to be less than the lowest price of those three, right? So this is the kind of constraints we can add. We know the price has to be under here. Same thing for this. We know the price has to be less than 0.4. So we know the price of these two things has to lie in this region. Okay, what else do we know? Can you think of anything else we know about the relationship between these two things? Ah, good. Okay, sum is what? Right, exactly. The sum of these two things is exactly equal to the probability of A and C, and the probability of A and C has to be less than the lowest one of these. So the sum of these things is less than 0.8. So we know the price has to live here. But this is where the approximation comes in. These kind of sum constraints, these are the hard ones. Like in general, depending what these securities are, knowing whether a sum of two things is less than some number that's NP hard. So kind of finding these things can be hard. So what we do is we find as many things as we can. But sometimes some of them we just won't know. So we will think. Sorry.
One thing I'm confused about is you assumed that the C, A, and B numbers were right, and that you wanted to find the A, B, and C, and A not B and C numbers.
Well,
but it seems like you want to optimize all these numbers at once and get them to be consistent.
That's true. Yeah, you're right. It's more like we're trying to make all of them consistent all at once. So I guess for presentation point of view, I was assuming they're right, but it might be that it goes the other way. So yeah, we know. So we'll just say the price has to stay here, but we might miss this. So if the price is actually here, we'll be a little bit wrong. So that's the approximation part. But if, like, let's say someone buys not B and drives the price of B down, now we'll basically run our constraint optimization, and we'll say we can find a violated constraint, and we'll move the price so it becomes consistent again with the constraints we know about. Yeah, so this is the way we are doing it for the election. So we start off, every state has its own security. Also, every group of 2 states has its own group of 4 outcomes. And if we have if someone wants to bet on a conjunction of 3 or more, we have a grouping of the conjunction and its disjunction. These 2 things sum to 1. So each group is basically a regular market maker, and that's super fast to do pricing. And but then in parallel, we are basically fixing all the constraints between these groups. And okay, what are the constraints? Actually, this is the part that is the sort of non-trivial part. Coming up with good constraints, and this is kind of an art. I guess it's a little bit more of an art than a science. So we can't enforce every possible constraint, but we can get some of them. So for example, using inclusion-exclusion type rule, we know the probability of a disjunction is always greater than the sum of the individuals minus the probability of the pairwise ones in any clique. And it's similar for if you take a spanning tree, you can get an upper bound on a probability of a disjunction. So we can use these kinds of constraints to fix some of the prices.
What is the graph you're looking at?
The graph is
what does spanning tree and clique mean in this context?
right. The graph is like the graph are I think it's just conjunctions that have literals in common. is the edge between.
So for each trade, that's going to be different.
For each what?
For each trade.
Not each trade, but each conjunction, or each type of prediction.
Sure.
One type of prediction that will be very important in this election example is threshold prediction. So, like, even just winning the election, who wins the election is a threshold on all 50 states. And or this other one that I said, like, Democrat wins more than 8 of the 10 northeastern states. That's a threshold prediction. And so we have some ideas of how to create constraints for thresholds. I guess one thing is one disadvantage of this approach is the type of bets you can allow. I guess the type of constraints you want are related to what types of bets you allow. In that, the one advantage of the Monte Carlo approach is it doesn't matter. You could come up with any crazy proposition, and the Monte Carlo works the same. But really, Monte Carlo has its own art to it of how do you tune it. So really, it's half a dozen, 6 of one, half a dozen of another. Okay, so that's. Let me just tell you some of the experimental results. So, like I said, we have this really interesting data set that in 2008 at Princeton did this. They advertised on 538. Do you remember, if you ever read Nate Silver's blog, 538? They advertised on there, and they got a whole bunch of predictions of exactly the form we want, which is, like, I think Republicans will win both Texas and Oklahoma, or I think they'll, for pairs of states and triples of states. And we kind of simulate a market, so it's real data, real predictions, but a simulated market. And here we have, like, this is for 10 states. So with 10 states, we can do the exact computation of 2 to the 10. For LMSR, this is like the sort of gold standard that we're logarithmic market scoring rule. This is the thing we're trying to approximate. That's here. You can see an independent market. So this log score is like the accuracy kind of. This is the accuracy based on the actual result of what happened in 2008. So higher is better. And this is how much budget each agent has. You can see independent markets, gets highly inaccurate pretty quickly. And then these are, LMSR does pretty well. And these are the different kinds of constraints we have. And if you use all the constraints, we're getting, this green line, we're getting as good or even sometimes better than LMSR. And one interesting thing is, so that's for 10 states, but for 50 states, remember, for all 50 states, we can actually do things that we're way better than independent markets, but we can't, it's just impossible to do LMSR. Well, it's intractable. And one interesting thing is, this is what I was saying about the loss bound, that in theory, our loss bound is just as bad as independent markets, but in practice, it's actually running at a profit. This is maybe going back to your question, that like we're taking out all this arbitrage, and people are making mistakes in their predictions or inconsistent predictions, and the market maker's actually making money. And we're, at Yahoo, we built this site called The Signal that we started in November at 0, and like, up to February, we were having like 2 million people visit the site every month. So, we a lot of things we do, like we try to do the theory and then actually build it for real and see what happens. Okay, if you want to read more, you can sort of read some gory details about combinatorial prediction markets here, bit.ly/combopm. This kind of more links to academic papers and things. This is like a more high-level, accessible thing, like a guest post I did on Freakonomics. bit.ly/combo PM free. So you can read more there. Yeah, so just like as I mentioned, a lot of the research we've done is it kind of follows this procedure. We'll think about something, try to design the market, try to come up with a good concept. But a lot of times, you know, the paper is beautiful and the math is wonderful and it's accepted for publication. But then we actually build the thing and we learn a whole heck of a lot. So that, I mean, not every time do we do that, but I really like to. This is rewarding to me. This stage, we're actually building and have real people use it and see what happens, and then go back and analyze it, and hopefully that helps you design it better next time. Okay, thanks very much for your time. I appreciate it.
So
Either one.
you could imagine trying to run a market where you didn't know the logical connections between various combinations of
Right.
bets. And there, in the current independent markets, there are people who know some connections between bets, and they can make bets about those connections.
Right.
Right? So
That's fine. In fact, that's what you want. I mean, if it's not, what I'm trying to eliminate is the very mechanical ones that a computer can do way better than a person anyway. So just get rid of all those. And if there's other more subtle ones that do require human intelligence, then it should be up to the human to put those in.
So, but what I'm wondering is, so maybe there's some information in these, what you call arbitrage bets.
Okay.
Actually, there's a connection between the two that maybe the market maker didn't know about, but some people did.
Okay.
I'm wondering if the best interface for that is independent market interface, or if there's some new interface where you kind of separate that out as, you know, these things are related to bet on that or something. I mean, because that was
right. I still think
that was part of your betting model, right? That A and B happen, right? I mean, that's people are betting a lot on that.
Yeah.
Well, then maybe that's a constraint that you can then take into account when you're solving for other. Is that?
Well, that's kind of what we're doing. I mean, I think it is still useful to have this expressive type language. So, like you said, if you just know, that Ohio and Pennsylvania are highly correlated. So you just want to predict, okay, I think they'll both go the same way. It lets you do that, and basically whatever information you have, you can give it in any form you want, and then the system will figure out what that means for everything else. So I still think, even for
so it seems like some kind of constraints you can learn. Like, so it's actually a constraint that these things.
I wouldn't call it a constraint, but that's just a. A constraint. I'm just talking about true logical, a logical consequence. That's what I mean by constraint. But you're talking about like a statistical dependence, and that's something that's just automatically part of this market maker infrastructure.
I'm trying to understand the problem. Can I view it as having a Bernoulli variable for every state, and then you have 50 of them, and they have a joint distribution that gives you some sort of constraint that you have to live with? There is a line of work in information theory that does something related, where the random variables are not binary; they're just an arbitrary discrete random variable, and it has a distribution. You have like 50 of them. Let's say only 5 of them are simpler.
Okay.
They're asking what are the possible joint distributions for all 5 of them. That's a constraint, and that constraint is not an entropy. So if you view this is called entropy vector, you have 5 random variables, and you have 31 different subsets of random variables, and we have 31 entropies, so it's 31 length vector. And that vector lives in certain space, and that space has a name. So people are have to try to characterize the exact shape of that region. That basically gives you all possible boundaries of that state are all possible information theoretic inequalities, and there have been studies on that. But so far, people made only to 3 random variables, 4 random variables, 9.
Okay.
It's a very, very complicated issue. But
Okay, interesting. Yeah, I'd like.
so if I constrain all the random variables to be binary, I think that's exactly your problem. In general,
I think you're right. And one interesting thing is this logarithmic market scoring rule is basically comes down to entropy, maximum entropy inference is what it's doing. So I think there's probably a pretty good connection. So maybe you can send me some of those papers. I can take a look. Pablo, did you?
Yeah, I guess my question is, if you made this market for real money, and let's say I'm a trader and I know that you're going to give me a price immediately right now,
Right.
but also you're going to take your time to propagate this information to other
Right.
prices, could I make a lot of different bets and try to basically steal money away from you with every trade?
Probably. I mean, so it depends how slow our propagation goes. But if you can do it faster than we can, that's why in theory our loss bound is actually no different than independent case. But because of this point that if every trader was purely rational and made no mistakes, then they would fix all the arbitrage themselves, and the market maker wouldn't fix anything. Like basically, if traders were perfectly rational, they would never put it into a state such that there's an arbitrage for us to take away. So in theory, our bound is no different than independent case, but in practice, I think people do. People make mistakes. They go too far with their predictions. In our simulation, they do definitely. We'll have to find out in practice. I have a feeling in practice people will too. So I think you're right in theory, but maybe that.
Also, the way you're running it, it's fake money, so.
Right. So we don't care as much. But yeah, I mean, I'd like to design. Part of the goal is to design it in as realistic way as possible, so you could imagine doing it with real money. So that's an important question. But the loss bound is still a loss bound of no worse than the independent market case.
Yeah.
So you still. You can't. For example, you can't like Dutch book the market maker to take infinite profit away. Still finite. Yeah.
Thanks again.
Thank you.